Hi everybody, thank you so much for joining us here on this video. So today we're going to be talking about iron butterflies, how to set up an iron butterfly, how to analyze an iron butterfly, and then how to set up the trade in the thinkorswim trading platform. If you haven't been here before, my name is Kirk with Tactical Options Trading, and we make videos just like this on a consistent basis where we talk about the stock market and options trading. If you haven't already, I hope you'll consider subscribing and clicking that bell while you're at it so you don't miss out on any future content. All right, guys, before we get started, I would like to welcome back all of our subscribers. I really appreciate you guys subscribing and watching our videos. I hope you find them useful. We love making these videos, so let's get right into it, you guys. Today we're talking about the short iron butterfly. So an iron butterfly basically is just selling a call credit spread and a put credit spread. It's basically the same strategy as selling an iron condor. But when you're selling an iron condor, you're selling those credit spreads far out of the money, where when you're selling an iron butterfly, you're selling them at the money. So that strike price, that sold strike price, or that short strike price is sold at the money. So what am I talking about here? So they share a common strike price. And if you're looking at a profit loss diagram of a put credit spread and a call credit spread, they look something like this if you're familiar with them. So when we're looking at a call credit spread, you can see here that the profit loss diagram of a call credit spread would look something like this, where the blue line is here. Now, when we're selling a call credit spread, what do we want the stock to do? Well, we want the stock to trade lower, right? We want to capture all that premium, and you can see that as the stock moves lower, we actually start to make money. Now, when you're selling a put credit spread, the opposite is true. So when you're selling a put credit spread, you want the stock to go higher. So basically, here's the put credit spread. We're just adding that in, and we want that stock to move higher. And so what that does, when we sell two of them together at that same common strike price, we're basically collecting more premium because we're selling those sold strike prices at the money. So we collect more premium than selling it at an iron condor. Now, an iron condor, we want the stock to trade in a range, and the same thing with a short iron butterfly. We want that stock to trade in a range, and possibly maybe even in a tighter range, but that's not the same. That's not the case in all situations, because you actually do receive a lot more premium or a lot more credit by selling those at the money strike prices, and so it widens out your break-even points. So let's take a look at it here. Let's talk about our risk and how risk is defined in selling an iron butterfly. So risk is defined by the width of the strikes less the credit received. So for example, if we were trading an iron butterfly and our strikes were $8 wide on each side, and we received a $3 credit, then our max risk would be $5. So let's take a look again at this iron butterfly profit loss diagram. So again, remember, we have the common strike price that we sold here. Now on each side of that, we're going to go out and buy protection. So on the call side and the put side, we're going to buy protection to protect us if that stock were to move really high or really low. So we're looking at the protection here on the call side and on the put side. Now that's going to be an $8 in this case. In this example, we're looking at $8 wide. So from the sold strike out on either side is $8. So we have $8 on the call side, $8 on the put side. Now let's say we received a credit on this trade of $3. Now that $3 credit is going to help move out our break-even points, correct? So when we buy when we sell that iron butterfly, we received a $3 credit. So our break-even points would basically be from the sold position where we sold those strikes, $3 out on each side. So we have $3 out on this side. The stock could move up $3 on the call side. It can move $3 down on the put side before we actually start to lose money. Now, how much money are we going to lose? Well, remember we have our protective put here, and we have our protective call. Now the difference here between the $3 that we collected and the $8 wide strike is $5. So the max risk in this trade would be $5 because once we passed our break-even points, until our protective put and our protective call start to actually make money for us at expiration, we're going to have a difference of $5. Now that would be our max risk in this trade. So the potential profit, let's talk about the potential profit in this trade. So the maximum potential profit on this trade would be the net credit that you received when you entered this trade. Now remember, we sold to open this trade and we collected a $3 premium, or we collected $3 credit to sell this iron butterfly. However, we usually don't wait all the way till expiration. We don't usually collect that maximum amount of premium and let that whole strategy expire worthless. We'll usually take it off about 25% of max profit. And we, when implied volatility really starts to drop, then we can start to see some of that that premium start to, we can actually buy that back for quite a bit less as that implied volatility starts to drop off. So let's talk about implied volatility. So implied volatility, or volatility, is our friend when we enter this trade, because we want to sell this iron butterfly when implied volatility is very high. So it's like anything. When you're selling something, you want to get the most out of it, correct? So we want to sell it when all the premium in all these options is juiced up. I mean, the market makers have put a lot of premium in those option prices, and so the prices of all these options has really shot up. So we want to sell at times when implied volatility is really high in order to capture as much premium as we can, or credit. And I say premium and credit, those are hand in hand. We want to collect as much credit as we can. But once we sell that trade, implied volatility is not our friend. We want implied volatility to start to go down once we make that trade, because if we sold this position and then implied volatility started to increase, well, those short strikes that we sold, those are really going to suffer a lot, because we don't want that implied volatility. That makes those options go higher, and we want to buy those options back at a lower price. So we want to see that IV, we want to see that start to drop once we make that trade. So increasing IV is going to actually negatively affect our trade. Now, time decay. So time decay, remember, when we sell options, time is also our friend. We want time, we want that decay to happen as we sell those options. So the passage of time will help our position as we're net sellers of premium, and as that time starts to pass, the value of those options will start to decrease. Now you can see here, if you remember from past videos talking about the option value and time decay chart here, you can see that from about 60 days on forward into the future is when we really start to lose a lot of the value of those options. And that's what we want when we're sellers of options. We want that value to decrease so that we can actually buy those back at a later date. Now let me go ahead and show you guys what I'm talking about here as we pull up the thinkorswim trading platform. Now, a couple of things to remember when we're looking at a trade. We want a lot of high implied volatility. So you can see I've got the IWM pulled up here, and you can see that the implied volatility is really skyrocketed here. We're at 93.2. And what does that mean? Well, it means that 93.2% of the time implied volatility has been lower than it has right now. So the stock has had a big move in the last little while. The last few weeks here, we've had some big moves to the downside, and so implied volatility is increased a lot, because a lot of people are like, whoa, this is just, a lot of fear in the market. So this is when we want to jump in there and be sellers of options when implied volatility is high. Now, what I like to do when I'm analyzing these trades is I like to use Fibonacci. Now, if you guys have ever used Fibonacci, I'm a big fan of it. I'm a big fan of Fibonacci. It's made me a lot of money. It's helped with lots of trades, and so I want to show you guys what I'm looking at when I'm talking about Fibonacci levels. So let's say, for example, we're looking at a trade here in the IWM, and we just want to snap a Fibonacci level right up here, and you can see that we are reaching some levels, and you can see that we actually reached this 786 level here, and it's actually broke through that level. And so if we put another Fibonacci based on this little rally before the decline, you can see that we're resting right now on the 1272 extension of that previous move upward. So let me go ahead and just erase all these that are on here now. And you can see, look at how these Fibonacci levels play out now. I've done some videos on Fibonacci's, and I'll link that right up here in the top, and you can watch those. But you can see that we're resting right here on that 1272 extension of this prior move upward. Now we've come up here, now we've retraced all that, and now we're extended back just a little bit, and we're sitting at that 1272 extension. Now most moves will terminate or just kind of fade out at the 1272 or the 1618. So what I'm looking at here is, because we're somewhat extended, I want to sell an iron butterfly, looking for the IWM to just kind of sit here and maybe chop along here, maybe even try to recover a little bit. And you know, once we start to try to recover, this implied volatility here is really going to start to go down, because of the fear is going to start getting sucked out of the market, and so we're going to start seeing that implied volatility start to decrease. So I'm going to look at putting a trade here on IWM. So let's go in here to the trading tab, and we're looking at the 21 December 2018 series. Now we're 52 days out from this from option expiration in this series. Now I want to tell you guys just a reminder. I'm not recommending you make this trade. I'm just showing you this trade as educational purposes only, and how to set this trade up in thinkorswim. All right, so let's go ahead and take a look at this trade here. Now let's say we're looking at where are we trading at here? We're trading at about 149.50 right now. You can see that we're trading about 149.50. So let's just call it 150. So we're going to come in here and sell the 150. And now remember, all we're doing is we're selling a put credit spread and a call credit spread at the same time. So what I like to do is I like to pick my two sold strikes first, and you can do that by holding down the control key in thinkorswim. So we're going to come over here on the call side, hit the control key, and click the call side as well. So you can see now that we basically have a straddle position. Now a straddle is basically an iron condor without the protective put and call that we're going to purchase here in a minute. So you can see that this straddle is selling for $11.25. Now what we want to do is come out here and buy some protection on either side. And so we're going to come out here and look down here on the put side. We'll maybe come down about $8 wide, and we're going to go ahead and click that control key, click the call side, and then we'll come over here on the put side, and then we'll come over here on the call side, and we're going to come out here to about the 158 mark and go ahead and buy that one as well. Now you can see that, of course, the credit that we received has been reduced quite a bit, because we actually had to buy those protective calls and puts. And so you can see that the maximum amount of credit now that we receive on this trade would be $6.25. Now that would be our max potential profit in this case, because when we sell this position, we're going to collect $625 into our account just for selling this position. But of course, we're going to buy this back at about 25% of max profit. So let's go ahead and take a look at this in the Analyze tab. So what we need to do is just come over here and click Analyze, right click, Analyze Trade. And here's our iron condor shape. You can see right here that we were just talking about. We have the iron condor, and you can see that we're selling that 150 strike, and then we have $8 wide on each side. Now our maximum risk is going to be that $8 wide but we did take in a $6.25 credit. So if we were to come back over here to the trade tab and we hit confirm send, you can see that our max potential loss on this trade is $173. $173 because we collected so much premium. We're collecting $626 of premium, and our max gain, max profit would be $627. So we're taking that $8 wide strike. We collected $626, but our max loss is going to be $173 on this trade. So let's go back and look at this Analyze tab. And what I like to do is come in here and click Set Slices to break even on expiration, which is 12/22. Now you can see what it did here is it drew these price slices right here out, and it shows us where our break-even points are going to be. So you can see that our break-even points are at 143.73 and 156.24. So we're looking at about a $13 wide break-even point on the trade. So we could come back over here and just actually draw those on the chart. But one thing with thinkorswim that I like to do is just come right over here to this little menu and hit Set Slices to Chart. Now when I click this, you're going to see it's putting two red lines here on the chart, and those are our break-even points. So you can see that our break-even point on the upside is 156.24, and our break-even point on the downside would be 143.73. So what that's saying is by expiration, which is in let me go ahead and put those on here. So expiration Friday, we're looking at the, let me kind of slide this over so you can see what I'm talking about here. Our expiration again is 12/21, and then we have our break-even points, these two red lines right here and right here. So what we want this stock to do is trade anywhere inside these red areas before we get to expiration. Now it can actually trade outside of those lines and come back in. And so what I'm hoping and what I'm looking for this to do is, since we've kind of come into some support here, is to maybe bounce along this support level and maybe try to make a little bit of a recovery. And even if it does go up a little bit, it's going to probably do a little bit of a pullback, hopefully do a little bit of a pullback, and that's where we're going to capture our profit. Now, who knows when it's going to do all this, right? I mean, it could go like this and it could be a total loss, or it could just sit here and, you know, chop along. But we're looking at taking this trade off at 25% of max profit. Now, excuse me. What I like to do, guys, is just, you know, some key points to remember when we're making these trades is to remember that, you know, we want to do it when implied volatility is really high. So again, IV here is 92.8 on IWM. We want to do it around support or resistance because we're looking for that stock to stall out, you know, come down into a range of support and stall out, and that way we can use that implied volatility decrease to our advantage, and also time decay as it sits and chops around these different levels. And then we want to know where our break-even points are. So the more credit that we can receive, the wider it's going to make those break-even points. So we want to trade it on high implied volatility stock so that we can capture a lot of premium so that we can make those break-even points a lot farther out. Now remember, we're also going to look at taking these trades off around 25% of max profit. We're not usually going to let these go all the way to expiration because, you know, what would happen if the stock did trade right in here and then right at the last minute it did one of these and took us right out of our trade that we had made money on and now became a loser. So we're looking at taking these trades off at about 25% of max profit, somewhere in that range. So anyway, guys, I hope this has been helpful. I hope it made sense. If you like this video, consider subscribing and giving us a thumbs up. If you think this video would be helpful to somebody, please share it with them. And if you guys have any comments about any future videos that you guys would like to see, put them in the comment section below down there. We love making videos like this, and we hope you enjoy them. Again, my name is Kirk with Tactical Options Trading, and we make videos just like this on a consistent basis We love having you on board. Again, hope you'll consider subscribing. Have a good one, everybody. Catch you later. Bye-bye.